Hello, and a very warm welcome to everyone joining us today for our webinar, Regulating the New Payments Normal, Opportunities and Challenges. Today's session will be hosted by Paul Swinton, CEO of B4B Payments and Chairman of BIF. Just a reminder to use the Q&A box on the screen, and we will try to answer your questions towards the end if we have time. So without further ado, I would like to hand you over to Paul to lead today's session. Thank you.
Well, good afternoon, everybody. Welcome, and thanks for joining us this afternoon, or later, whenever this edition is published. I'm joined by a great group today. We had a good chat yesterday, and got to know one another. And we're hoping we're going to give you lots of stories and anecdotes and information that we've gleaned over the last several months. But really, the reason for being here today is that we got a whole new set of working conditions alone with COVID hitting us in the last 12 months. But throughout all of that and permeating all of it, there's been a whole bunch of other things to deal with on a legal and regulatory side. And what we're interested to understand from the panelists today is how that's affected them and their companies, what the opportunities have been, what the lessons learned have been, and ultimately we're going to try and see if we can solve for the future in some way. So we've got a few topics to go through. So once again, my name is Paul Swinton. I'm the CEO of B4B Payments. We're an e-money regulated firm in the UK and Lithuania, and issue prepaid cards mostly to corporates throughout Europe. And we also have a business that we run in the US as well in the same field. So I'm going to ask everybody to introduce yourselves, just give a brief overview of your companies, what your company specifically does and what your role in it is, and then we'll crack on. So ladies first, Laura, over to you.
Hi, good afternoon, everybody. I'm Laura Oyesonia, and I'm the General Counsel and Chief Risk Officer for Contis. I'm a solicitor by profession. Contis issues and processes payments, and we are a principal member of both Visa and MasterCard. We have offices in the UK, Lithuania, and in India. We basically service a lot of clients like fintechs, banks, to enable them to be able to do some of their banking transactions and issue card payments as well.
Thank you. Seb, how about you? You're next.
Yeah, Sebastian Riccardelli. I look after payment and prepaid strategy for a company called BlackRock Network. We have multiple products across Europe. You probably heard of the OneFall product that we have in the UK, but we have also B2B product that we sell to companies in the UK and essentially in the UK and Ireland. We have offices in the Netherlands, Ireland, UK, mainly, but we also operate in the US. We have two e-money institutions, one in Ireland, one in the UK, and we are principal members of Visa and MasterCard as well.
Thanks. And Mitch.
Thanks, Paul. Hi, everyone. My name is Mitch Brahan. I am the UK Head of Compliance and MLRO at Banking Circle. I've been involved in the payments industry for around 18, coming on 19 years now. And Banking Circle, it's a recently formed bank. So we actually obtained our banking license towards the end of 2019. And our client base is, in the majority, other payment institutions, e-money institutions, other PSPs. Indeed, when other financial institutions, credit institutions have been de-risking this space over the last few years, in the last rolling 12 months, we've onboarded over 50 new relationships because we're specifically focusing on the risk of these types of relationships and how to best manage them. So that's me, and that's Banking Circle. Thanks, Paul. Back to you.
That's great. Thanks, Mitch. Okay, folks. Well, as we said, lots of things have happened over the last few months. Many of them are still ongoing, all the old favorites. So some of the things we're going to be touching on today are primarily around PSD2, which is still lingering around, the old P word. I know we want to touch on some of the impacts of AMLD5, particularly in the gift sector. Seb, you wanted to have a chat about that. Very recently, in fact, this week, there's been new requirements to go live with cross-border payments regulation. So we'd like to talk about how we're all coping with that, what the effects have been on us and on our consumers. And finally, kind of quite recent news is the FCA consultation, which is closing shortly. So we've all got some thoughts on that as well. So I'm just going to kick off with SCA and PSD2. As we know, parts of SCA were delayed in the UK and across Europe for various reasons, mostly COVID related, merchants' ability to install and so on. So I'd just like to kind of open it up and just try and understand from your different perspectives, what have those impacts been on us as issuers, banks, and potentially merchants as well, and what's still to come, and what have been any lessons learned that we've had come out of that? Who would like to jump in on that one? Laura, I'm going to put you on the spot.
How did I know you were going to come? I think it's been quite interesting. I think in some respects, a little bit of time to try and get our house in order in terms of getting the SCA in place has been really good. But when you're working across jurisdictions with UK and the EU, and the UK no longer within the EU, then you have all these sort of reporting requirements that you have to meet. You know, how you set up your processes, how you ensure that you can, confirm that you're compliant for the merchants, to be able to sort of deploy the two-factor strong authentication. So it's been kind of sort of mixed views, really. Yes, we've had a bit of time to prepare, but still, there's still all the niggles and all the things that you find along the way that you feel that you need to fix before the regulators, start getting excited. And because it's so different in terms of how far they've advanced, and when you look at what's happening in, within Europe and what's happening in the UK, it sort of just make it a little bit more difficult to sort of juggle the balls and get everything in order.
And have there been particular countries in Europe that have been particularly ahead or particularly far behind that you've come across? Or
well, I think it's very interesting because we've got an entity in Lithuania, and I think they've kind of sort of ramped up. They're kind of preparation in terms of, because I don't know whether you know, but I think one of the facts that I found out today was there are about 89 or something like that fintechs in Lithuania, and it's just like, wow. And because of that, the Bank of Lithuania has been kind of very busy in terms of trying to get all the infrastructure and all the systems, get the gear in place. I think it is fair to say that there's a lot of time invested and guidelines given by the Bank of Lithuania to sort of get everybody ready. But it doesn't help that you have differences in time that you have to do the reporting.
Yeah, I mean, we're also in Lithuania, and there's certainly challenges even in registering the reporting due to the infrastructure, I'm aware. So Mitch, can I ask you this? I know that you're not necessarily directly issuing, but many of your clients are, and I wonder if there's anything that you can share about how they've perceived the speed of implementation, and if there's been any issues raised that in particular you may have had to deal with.
Of course, no problem at all. Thanks. So from a bank's perspective, there's two aspects that specifically are relevant to us. One is, how does it directly impact us? And the first one is, it has to some extent, but not the same as some other banks due to our client base. So for example, we don't have consumers as our client base, and we don't have many direct merchants either. The majority are all regulated institutions. And when you come to those aspects, there's a number of exemptions we can directly, when we're communicating with our clients, that we can take advantage of. So there's the corporate exemption and the corporate IT infrastructures and how we can authenticate that communication. A lot of communication is done over SWIFT, which is an authenticated message system. So that gives a lot of client to bank interaction. When we address strong customer authentication, we cover it off in those. And where firms can't use that, then we do have an authentication app that they can use. But then also when we are looking at our client base, we do during our onboarding process is look at fraud risks and the money laundering risks, etc., that go on to that. And when we look at fraud, that's the real reason for strong customer authentication. So we're always keen to see which firms have implemented it, how have they implemented it, and where they are on that journey. And from what we see, there's still a large differentiator between all different firms. Everyone's chosen to implement it in a different way, different rationale, different pieces. There's no consistent industry or market answer, except for the something you are, something you know, something you have. So, I mean, does that give you the sort of flavor you're looking for, Paul, or is there something?
Yeah, I think it does, and I think you're right. Probably one of the issues which we've discussed within PIF a few times is about relevance. I mean, we sort of, is SCA relevant? There are exemptions, as you mentioned. There's very different interpretations of some of those exemptions.
There are.
You just mentioned corporate there, and if you talk to some people, the corporate exemption is a really, really, in fact, if you look at the EBA answers on what is a corporate exemption, is very, very specific.
It is.
And not very wide-ranging at all. So perhaps the lack of guidance, information has opened it up in terms of interpretation, and it'll be interesting perhaps to see over the coming months and years how it's enforced.
Completely.
I think that's a very good point, though. Sorry, Paul. I think that's a very good point, but I think the reason being that the whole point of the SCA and how you look at the best deployment depends on the type of businesses you're dealing with, and that's why sometimes you need to refer back to the RTS, the technical details, to be able to sort of decide on how best to structure it to make sure that whatever structures you have in place are compliant. And then there comes this sort of reporting issue, because if you decide to apply a corporate exemption to a particular type of business or client, when you have to do the reporting, you have to be able to justify, the sort of thinking or the logic, which must in some ways, follow the technical details that you have within the RTS. And I think that's the challenge. And that's why, sometimes you can't, have the same for everyone, because businesses are kind of different and they operate in different ways.
So what you need is a great in-house lawyer to be able to to write all this down for you, right?
It does
and justify the position, because ultimately, yeah. Because I guess go on.
And I was just saying, it's still quite early from the way I look at it. Firms do have to do their report, right? What is the Rep 017, 018, and they've got pieces of, well, what were your transactions? How much was strong customer authentication applied? Right. And as the FCA starts obtaining these, reviewing these, and we see further down the path actual check back and challenge from regulatory body, that's when we'll start getting a real understanding. Just I don't want to say cases, but that's inevitably the way industry learn. They see when the FCA picked up on some players, checked, challenged, issued more guidance. We're still in a bit of infancy here, and I think one thing that's common across everyone we see is everyone is trying their best to implement something to prevent fraud. They just have different ways because everyone's model and systems are different. But yeah, the FCA and what they do next is going to be key to drive what we do.
Yeah, I agree.
So Seb, can I just ask your opinion on this? You obviously operate predominantly with a product which is quite low value, anonymous. How has this impacted you and your business model?
So, of course, the side where we have the gift cards is been impacting us, but not as much as the other products, obviously, which is similar to what you are selling. So, effectively, a product that is sold to employers, for employees, rewards, incentives, etc., or benefits. But from the gift card product, we haven't seen that impact, unless it was for some sort of a reloadable product that we are selling and things like that. So we've been playing catch up really, because some of the product, and it's a very small portion of the product that have been impacted regarding this, because most of our card are anonymous, obviously, and then we don't know the customer. But I think when we look at what it's happening and how the regulations are changing, etc., we're a bit nervous in a way, because we think that it will affect our business in very shortly, effectively.
Interesting. Okay, so we talked about the SCA. I mean, SCA is at two levels, obviously. One is account access, and one is obviously card usage. As we said, there's been a huge change not necessarily change. There's different ways that's been implemented. Obviously, people with apps can do bio authentication, but there's been a huge upsurge in things like SMSs, which is I don't know when the SMSs started, probably in the 1980s or something, but it's been a huge resurgence in SMS usage over the last couple of years as a direct result of this. But what's your impressions as how do all these different new authentication methods, how are those being adapted to by the cardholder or the user base, the wider user base? I mean, clearly it's creating a bit of friction, but are people overcoming it? Are we seeing any drop-offs in transactions as a result of this friction? Or any comments on that at all?
I think from my perspective, I think I'll look at it from both a personal and, business perspective. I think, these days it's so usual, to get alerts, you get your direct debit page, you get an alert, did I actually authorize that? I've had this many times and looking, what's that mean? So that's kind of been very, very helpful. But I think if you look at the heightened state that we are now in terms of fraud, scams and all sorts, I think in some ways you think, yes, this SCA, it's really good. It builds trust and confidence. And yes, definitely we've got to find a way to work with it. But then when you look at this sort of from a business perspective and all the sort of kinds of infrastructure you need to put in place, and now that everybody's kind of working off the app and off the smartphone, it makes it, that doubly difficult in terms of the investment, in terms of, having the latest technology, because there's so much competition. And what it boils down to is the level of service, that customers can relate to. And that puts a lot of pressure on the business in terms of how to, sell your services, gain the trust and confidence, have the high level of involvement that will ultimately contribute to the bottom line, and also making it all frictionless. So I think
so we have to become UI and UX experts rather than anything else, rather than payments experts.
Yeah,
that's interesting.
I think it depends on the audience as well. We've seen we do lots of analysis on the customers that are logging to the platform or using the product, etc. So we have digital analysts that analyze this, and it really depends on the audience. So we tend to see less problem when it's a younger demographic than when it's an older demographic. So that is how we try to monitor this sort of consequences of this.
Yeah, that's interesting you mentioned that. And Mitchell, I'll just give you a quick anecdote of my elderly mother. I mean, she basically can't use online banking anymore. It's impossible. It's just too complicated. They're either phoning her, sending her an SMS to her mobile phone, which she refuses to switch on, and so she can't use it. And then you get into all this kind of issues of third parties, including myself, having to try and access for her, and then so in that demographic, sometimes it can become almost it's taken the opposite benefit. Well, it's taken away the benefit. But Mitch, anything from your side on that, just in terms of observations that you've seen?
No, unfortunately, given where we sit in the chain, we don't have that direct underlying customer interaction. Only my own personal piece, and from my own personal thoughts, it's everywhere. So if I use one firm versus another, I'm not going to not do what I need to do because I have to go through a friction process. Everyone's subject to the same rules. So yeah, there's nuances. Some people are slicker than others. I'm not seeing too much of it. And it might just be because I understand it, right?
Yeah.
You know, what would somebody else on the street all of a sudden say, what is going on? I mean, I've got a different viewpoint. So other than that, I'm not going to add much value, so I'll stop.
Okay. Okay. All right, let's move on to another piece of PSD2, which is, again, we've had a number of discussions about this over the months within PIF, excuse me. And this is around take up for TPP services on our particular products and services. There's been a lot of information from providers in our organization that there's been little evidence of TPP take up for their products, because they believe that the third-party demand for those products just simply isn't there because of the nature of the products. And whether that's gift, Seb, in your world, in our world, corporate, there hasn't been a great deal of TPP take up. I just wonder if we'll spend 5 minutes just talking about that and just understand if you're seeing any big uptick in our areas, and generally what your thoughts and impressions are about the big bubble that is open banking and TPP access. I need to pick someone to start. Seb, you go first.
Yeah. For me, it's actually quite easy because we almost have none because of the nature of the product that we have. So it's very limited where I can comment on this because from a gift card perspective, it's not something that people will necessarily want to use anyway. So we do have launched something new for gift card where we provide a little bit more transactional information from a user perspective, but it's not something that you would necessarily use from
TPP.
Yeah, a TPP.
Yeah. Okay. And Laura, any thoughts on this one?
Yeah, I think this is a fascinating one actually, because everyone was so excited when the open banking PSD2 phenomenon, was sort of the thing. And fast forward, and that take up isn't just there. I wouldn't say the sort of excitement actually turned into becoming de facto what everybody's doing. A lot of the banks have already implemented, the sort of opportunity to have the aggregation of all your accounts in one place. And I don't know if anyone, frankly, that's kind of been bold enough to say, yeah, I have all my accounts in one place with one bank, and then access it. So I don't know. I think maybe because it's such a new it's not such a new concept, but it's something that will gradually maybe take effect. But right now, we're not seeing that huge take up that everybody anticipated.
Okay.
And
Mitch? Oh, sorry.
Sorry, Paul. I was just about to ask Lara if she thinks that is because of a trust issue or something like that, or do you think it's because people don't trust it and then they don't want to do it, or is it just because they're not interested to have it, or
I think it's a trust issue. I think everybody gets personal, when you suddenly feel that you're giving somebody access to your bank account and an account that could have your current, your savings, everything together in one place. And then you give a TPP access to that, and you don't, even if it was for a specific point in time, you go back to check whether that access is still there, with all the usual noises everybody's hearing about data, loss of data. I think it's just frightening, from a sort of individual level. And I think we need that buy-in, to be able to make open banking,
there's got to be a reason to do it.
Yeah.
There's almost got to be a benefit. I mean, I remember, when this was all coming around, I think I was going through a mortgage application at the time. So I'd literally just printed off pages and pages and pages, scanned pages and pages and pages. and somebody came up with this idea of, oh, with open banking, you'll be able to click a button, they can see all your bank details. You don't need to do all that. For me, that would have been a godsend. Now, fortunately, I haven't had to remortgage in the past year. But you know, if there's a real benefit that I can almost touch to doing this, I guess I would do it. But just for the sake of, you know, look, I mean, first of all, how many people have multiple bank accounts or multiple accounts they need to see in one place? But so I think it's really got to be a genuine use case that the users can see the value.
Yeah.
So the aggregation model may have been over-egging it perhaps.
Yeah.
It's interesting because if you look at Open Banking's website and Statista, which gives a lot of data, and I'm turning because I'm looking at it here, they're saying that the API volume, the call volume, increased from 66.8 million in 2018 to nearly 6 billion in 2020. So they're saying there were 6 billion API calls through TPPs in 2020. So that in 2 years is, what is that? That's 10 times, more than 10 times, right? The uptick, 100 nearly. And that I find interesting because I share what other people have said here. Whereas I don't use it, and I don't know anybody that does use it. But one thing I have seen firms start to implement is, well, two things. Some authorized payment institutions got rid of their payment accounts because they wanted to avoid the need to open up the sockets, if you will, for TPPs, just due to the cost of compliance, which is an unintended consequence of this coming out. And then on the flip side, I know some firms that offer services to corporates, and part of that includes credit. So you mentioned the mortgage application. I know some firms are starting to develop the APIs that they can see into their corporates' clients and actually monitor the credit risk that those clients face, and, at the onboarding stage and throughout, and actually facilitate allowing those clients that give them access to have better settlement lines and those types of pieces. So I know there is some use case there, and people are starting to build. But apart from that, there's not much I'm seeing on the consumer side, at least. Definitely on the corporate side.
Well, that's interesting, because obviously it was very much muted as a consumer benefit, but in actual fact, it's actually the corporates that potentially are getting the benefits of this. That is interesting.
I've seen it, Paul. I've seen it with where we have multiple accounts from a business perspective and multiple cards where they want to aggregate everything into the accounting system, for instance, or something like that. They use it a lot for that. But yeah. Okay.
And Mitch, you touched on it there, but the the costs of compliance obviously is significant, and you mentioned situations where people are almost deregulating themselves in terms of payment services to avoid the cost of compliance. And this is the reason it's kind of been top of mind for many people in PIF in the past, is the cost of compliance are huge when effectively the zero take up. The cost per transaction is almost infinitesimal. So and I think Laura and Seb, from what you've been saying, there's very little take up of those services, and I mean, I know we certainly see this as a cost of compliance. There's not a huge benefit at this stage. Looking forward to seeing some of these opportunities in the future, but not at the moment. Is that fair from the panel, or
yeah,
your views?
I agree. I know a lot of people that have built it and are actually, where at the start they were like, I can't believe we have to build this. But now we've built it. I want someone to please use it. Right? But they're proud of what they've designed and built, and they have to do it. And everyone got involved. And it's almost a bit of an anticlimax, a bit disappointing for some of the tech and compliance guys that built something that just then nobody's really using as much as the people envisaged.
No. Okay, well, yeah, I think that's probably. Is there anything else that anyone's got thoughts on PSD2? What's coming? What's going? What's in the future that we want to raise?
Well, I think just very generally and very quickly, I think we shouldn't underestimate the impact that PSD2 has had on financial services, even in terms of increasing the awareness, the opportunity to tackle financial crime, fraud, which is increasingly becoming the bane of everybody's lives. And actually, at the time, I do remember when the regulations were first passed, and we're kind of all racking our brains in terms of how do you make this work, what's going to look like. And fast forward, we are actually, we've kind of sort of got into it, and it's like used to the two-factor authentication, know what strong customer authentication is. And, sometimes you're just so thankful, that if you're shopping online, you have that sort of confidence, that there's some sort of security that helps you to not to worry too much about shopping online. So I think that's, huge leaps, that's been made for financial services.
Yeah, and obviously hugely exacerbated by everybody being in their homes pretty much
Exactly.
for the last 12 months as well.
That, COVID will be the panacea, for demonstrating why this was a good idea in the first place. Yeah.
So let's not get onto conspiracy theories here about how that all started, but okay. Well, let's move on from PSD2 because there's lots of other things going on at the moment. So cross-border payments regulation. This is a CBPR2 is this kind of latest incantation. So this was well, I'd appreciate your views on this, but this was a regulation which was kind of brought in by the EU. The UK continued adopting it through post Brexit. Again, it's not hugely clear whether they meant to do that or it just kind of happened. But particularly this week, there's kind of new requirements to start comparing all FX transactions against the ECB rate. What's an ECB rate? We hear most of the consumers saying, but never mind. I don't want to cloud the discussion with my own views here. But what's been the impact, both from CBR1, really the bit that was a year ago, showing these amounts, and then the more recent bit, as it's quite early, quite recent rather, the second piece. But has there been any feedback from your card holders, users, and more broadly, do we think there's been any unintended consequences of this legislation? Mitch, go on. Let's start with you.
It's a really interesting one, and through another trade body that I'm heavily involved with, there was huge amounts of conversations with the FCA. So the FCA set up what they call the Currency Transfer Engagement Group, and it was addressing CBPR2, transparency requirements, what should consumers receive, when should they receive it, how should they receive it, and again, not only to them, what is an ECB rate, but also, is there such a thing, and how would people get the same rate? Because there was also talk of a mid-market, but which mid-market? Are you talking Bloomberg? Are you talking another provider? There's all these permutations that came out from these meetings. And one of the real interesting pieces, and I was just looking online to see if I could find it to share with the group. But if you spend a bit of time Googling the FCA's Currency Transfer Engagement Group, they actually...
that was the next thing on my list to do, actually, Mitch.
I thought it was. And there's actually a load of data that the FCA did. They actually got a load of individuals to come forward and test it. Here are 4 different results on prices, and this is the one that complies with CBPR2. And would you know the difference and which to go for and how to go for it? And analyzing the fact that FX rates are actually dynamic. So if you went to one provider and got a price for the rate, and then went to another provider and you ended up with more euro for your sterling, is that because the second provider was cheaper? Or were they actually more expensive and the rate moved in your favor? Should you have actually gone back to the original? And they couldn't really, the consumer generally wasn't able to always manage to identify, this was the cost of the service, this is what I'm getting for it, and this is what the implication was. So that was a really interesting outcome as a part of this, the FCA's rollout of this. But what was secondary and really interesting was the wording of the legislation and then the implementation of that. So the wording was very much that if there's an FX as part of the credit transfer, but what if the system that you have and the contracts firms have with their underlying consumers isn't one. What if there was, you pay money from yourself to the firm, that's one transaction. Then there's an FX. So euro out, sorry, sterling out, euro in, there's your FX. And then there's a euro to euro transaction that goes cross-border. None of those trigger CBPR2 requirements because there's 3 separate transactions, and at no point was there a credit transfer with an FX built in. So again, it's really interesting about the implementation of CBPR2 and the different ways of doing that. I think, you know, taking it all the way back, what was the spirit of the legislation? What was trying to be achieved? I think there was more about trying to make sure consumers were well informed. And again, the FCA testing comes across as, well, how do we really best achieve that? People still didn't quite always get it. And then, you know, are people paying too much? Was there what was happening with DCC? And I call it out. I know it's a controversial piece, but DCC was expensive for a lot of people and there were complaints.
Yep.
Is that the driver behind this? And I'll pause there to see what colleagues have to say.
Yeah, go ahead. Lara, Seb, do you want to?
Well, I couldn't disagree with anything that Mitch has said, actually. And I think, as always, the intention was a very good one in terms of ultimately, you know, thinking about how the consumer benefits, you know, in terms of not to be, you know, to have cheaper payments and i.e. if it's an intra-euro rates to get the benefit of that, which generally, you know, comparable to the domestic rates. And also the issue of high level of transparency, I think all very, very, you know, good idea from this sort of consumer perspective. But then when you look at the business, you know, who's going to try and ensure compliance with all of this and build infrastructure to make sure that they are able to comply and also to be able to justify that they comply, it becomes a very, you know, very big issue and can, you know, cause a lot of headaches, I think.
I think perhaps they underestimated just how complicated payments are or can be.
Especially cross-border.
Yeah, and I think Mitch, you touched on a really good point, and we were looking at this yesterday, is because different providers, the ECB, for example, publishes a daily rate. You know, schemes are giving you 5 or 6, I think, intraday, but other, you know, FX providers were doing it real time. So, you know, you're never comparing apples with apples at this point, because you compare the ECB rate at Monday in the morning before a crash, it's completely different. And what value is that giving the consumer at that point?
And then you come to the cost of compliance, which was very much relayed back to the regulators of, have firms set up their systems to actually, through API calls, have an ECB rate that they can relay over? Or is it just their own liquidity provider's rate? Because that's what they care about. That's their cost of buying it from their liquidity providers. Not everyone's a market maker. So that ECB rate or those other rates, Bloomberg rates, it means a lot less. It's, what's my liquidity provider's rate? Can I give that to the consumer? Is that akin? But actually, no. And I could go on.
And they're always different. And they're always there. In fact, I remember anecdotally at the time when this came out, the ECB didn't even publish their rates in a readable format. So I think that obviously has come since subsequently. But, you know, I think the ECB was probably more shocked than anybody else when this legislation came out. But Seb, have you got any thoughts on this? Has this impacted you much at all?
No, in a way, I'm glad that it doesn't, because we cross-border, and we tend to. I mean, as you know, Paul, we're looking at open loop and probably doing some cross-border, but at the moment we are using, of course, specialists that they know what they're doing, because for us it's kind of new, and we do lots of. We issue lots of cards in the US that are spent, you know, a bit in Europe, a bit in different countries, but that's something that I'm not too close to yet. But yeah, it doesn't affect us at the moment.
Okay, so I think maybe just to summarize on this then, I think this was a well-intentioned piece of legislation which didn't necessarily understand the implementation impacts in the first instance, and probably the scope was a little bit, it's caught too many people into this, which were probably the unintended consequences. Is that So seems reasonable. Where have we heard that before somewhere? I don't know. Perhaps in the earlier discussion. So let's talk about some of the other things. So AMLD5, there's been a few things. So there's a reduction in limits on anonymous cards. Has that, the intention there, obviously well, if we think back to what the intention was there, I guess it was to stop anonymous cards. It's effectively the way it was built up, and that was probably with a view on counter-terrorism measures and so on. You know, was that on the money? Was it? Has it achieved its objective? Has it gone way beyond and affected genuine business cases? Seb, that's probably
yeah. I mean,
one for you.
Of course, we've been really affected by this because most of our cards are anonymous, so we've been really affected by this. Even more when we had some anonymous cards that were rejected online by PSPs that were located in Europe and apply the €50 limit in the UK. So that was something that really affected us. It seems that is slowly getting resolved with, implication with Visa and MasterCard, because they shouldn't block those cards. But what really affected the consumers is that €50 limit in Ireland, for instance, where they couldn't shop for more than €50 online. And considering our type of product, which is, or we position it as a low risk because it's restricted to certain merchants, it really has affected our business model. And we're getting customers obviously don't understand the fact that this is an e-money product, and therefore they don't understand why they cannot spend a gift card online, for instance. So that really has affected us, and we had to adjust our way of working.
So in particularly more so over the last 12 months, where they haven't had the opportunity to spend it in the real world.
Correct.
Yeah, okay. So just so everybody, just for people watching, can you just quickly, what are those limits? So it's €50 online, and is it 150?
150 euros, that's the limit on the card, yes. So most of our cards are in Ireland between 15 and 150, in the UK between 10 and 120.
And what was it before? It was 250, was it before?
It was 250, and I think before, it was even before my time, I think it was even 500.
Yeah. So. And did you, when that went from 250 to 150, was that segment, was that big for you before, or was it limited impact?
Essentially for B2B was, for consumer, on average in the UK, you have probably about 30 pounds average basket.
Okay.
And in Ireland is way higher because we really have a big market share in Ireland. But it really affected what we were doing with B2B, and we had to adjust the business model and the way we sell those products through B2B.
Yeah. And Laura, within Qantas, do you do much in the anonymous world, or
no, not really. But I'm sure some of our clients will, probably do that, but it's not something that is big for us.
Okay. And Mitch, it's not your game. No. Yeah, I mean, I must admit, from our side as well, we have very limited, if any, anonymous now, because it just became too much trouble, frankly. Okay. And so that's interesting. So you were saying that the acquirers, so this is maybe a little Brexit learning, the acquirers weren't aware of the national differences.
Yeah, and they just apply the rules that they apply in Europe. They applied it in the UK as well.
Right. Okay. So we've got acceptance issues.
That's why acceptance was a problem. It's not all the PSPs. It was just a couple of the PSPs that were located in Europe and acting in the UK.
I see. Okay. So another topic we thought we'd have a quick chat about is there was some rumblings a couple of months ago now about coming out of the end of the COVID crisis and how we're going to pay for it. And there was some discussions about, you know, shall we follow the European model and look at negative interest rates? And it's not just here in the UK, there's been other mumblings around the world, actually. Let's just have a chat a minute about, you know, first of all, you know, there's been a negative interest rate in Europe for, God, so quite some time now. Mitch, you'll know that better than me, but it's been months, if not years, I think. And clearly, if you're holding client funds, as most of us do here as EMIs, there's a real cost to business of holding euros for most banks, with most banks that are safeguarding those funds. You know, if this was to be applied in the UK and elsewhere, what would be the impact moving forward? And what do we think we should be doing as a trade body or a group of interested parties to try and, you know, if we possibly could, influence Treasury and beyond as to the impacts on us as businesses? So, Mitch, let's start with you as a bank. You know, obviously you're in this position where you're holding funds with ECB, you're paying negative interest rates. You know, what would be the impacts on you as a bank, and then more widely on your clients and EMI clients specifically?
That's a dark question.
Yep.
Let's broach it. So yeah, I think you mentioned years. I mean, I know it originally went negative in around June 2014. I don't know if it ever did go positive after that and then went negative again, but if it did, it wasn't for a long, right? It's been negative for a while. And look, it is exactly as it sounds. It's a cost for any bank to hold that liquidity balance. And respectfully, all the banks are saying the same thing of, yes, we want to lend, but then there's also the financial crisis that happened historically and responsible lending and credit issues and who should we not? And actually, that's creating its own conflict within a lot of institutions. People are tasked with lending and the credit guys are saying, no, you can't. And then there's a negative interest rate, which is costing their treasury additional money. And what's starting to happen is banks are starting to now charge firms for their euro balances. Now, we could get into a really deep economic debate, and I'm not even, you know, an economics professor, but and I've read some of the articles out there about, is there benefits, are there not benefits? Does this quantitative easing and does it really get economies going again? Why don't you just spend money to build houses, et cetera, et cetera, et cetera? And I'll be honest, I don't know, but all I can give you is that practical answer of, yes, it's hard for banks who are losing money with euro balances. I know some banks are rejecting euro balances. I know some banks are charging more for the euro balances. A lot are doing it just to cover their costs. Some are actually using it as a form of income. That's that. And then all those concepts all apply if the same thing happens to sterling. One thing I can share and do know is the Bank of England have reached out to all the UK firms, all the UK banks saying, have you seen about negative interest rates? We're checking your ability to implement if this were to happen. We want to know your resilience. We want to know how long implementation is, the cost of implementation, and making sure that the banks are ready. Some people are saying this is an indication that this will happen. I'm not sure. I think people are being protective in case it happens, and I don't think the in case should be read as it will. But that's just my own personal opinion. I've got nothing to back that up.
Well, it's been recorded, so we've got this for posterity. So
of course.
We'll
so there's it from what I see in my point of view. If that's
and the other part of the question that I touched on there, and I'll ask the others because this directly impacts their business on this, is obviously, as Mitch has said, this is cost of doing business, and you know, and if it happens in sterling in addition to euros, then it's for many of us it's a much greater increased risk of business. But fundamentally, is it right to charge people that can't lend, like EMIs or PIs, and and have to hold safeguarded funds or trust funds, or even wider in the solicitors holding client funds or things like that, is it right to be charging those people this money when they're holding client balances? Is it? I mean, I'm probably, we're all nodding our heads no, morally it's wrong, but is there an argument, is there perhaps a legal argument, Lara, I'll point this one to you, to say that this is not right?
Yeah, as a lawyer, I'll probably argue both sides,
Of course you will. And you'll charge us for both arguments as well, so yeah.
Well, what am I thinking? I think there's an argument, when you say there's no choice as an EMI, you have to safeguard those funds in a credit institution, and they're not your funds anyway. So why should you be charged for it? But there is a counter argument that as an EMI, you're running a business. And if one of the requirements of running that business operationally is to safeguard those funds, those are costs of the business that you need to allow for. And also the credit institutions are providing a service to enable you to meet your regulatory obligations to continue to do business. And if I look at it from a sort of very basic logical conclusion, I think it's going to be very, very difficult, to argue that EMIs shouldn't pay, for it, because credit institutions are providing a service. It's part of your operational costs of running the business, which by choice EMIs are running. And to do that, you need a license. And to keep your license, you need to be compliant. So I think, it will be difficult to argue not.
Thank you, Lara.
Are you going to give us the other side of that right now? No.
No, I mean that's my side. Well, right?
But Seb, I mean, from your view, I mean, obviously, those of us that are in issuing, we're running on relatively tight margins.
Yes.
What would another, half percentage in terms of, holding costs, or perhaps even more, how does that affect the business model? And does it get to the point where products may drop out of the market because it becomes long-term unviable? Is it a cost that we see there's an ability to kind of somehow off charges to our clients and customers?
Yeah, and again, it's down to, well, the business model becomes very tricky. To us, even more with COVID, we've been affected by this because customers couldn't spend their money, and therefore we had more money on the safeguarded accounts, and therefore we had to pay more regarding those negative rates. So this really affects the business and really affects the consumers as well, because the proposition is still something that the customers want. And if we start adding fees just to maintain the balance, to protect them, it feels like it's a bad proposition for them. So I think we really need, as the industry leaders, we need to look into this, because it affects those customers, and we need to look after them. I'm a big believer that customers need to have a good experience to come back and spend more and be happy about it. And if we don't look after them, we will be out of business, basically.
Yeah, and it's difficult because the consumers don't understand it. It's because broadly they've been shielded from it because banks typically make money in other ways. Okay.
Timing as well. It's who goes first, because if someone does start doing something, everyone will just move their business. And this is at all stages of the value chain. And if this guy's not charging and this guy is, I will go to the guy that doesn't charge me. It's how free consumer banking started in the UK all those years ago.
Well, let's not go down that rabbit warren of how that gets funded by certain investment partners. Yeah. Okay. Well, we've got 5 minutes left. We're going to just move quickly on to a couple of last things here. there's an FCA consultation that's closing soon. Some of us were involved in it. I'll just chuck out a few things that were involved in that. Increasing contactless limits, it's kind of happened politically, it's moved by. They asked for our opinion, and then I think within a week before it even closed, they're announcing Parliament it was going up. You know, we'll be interested to hear maybe quick views on that. But the bigger ones, I think we've got some good opinions here around safeguarding trust accounts and de-risking. And finally, the biggest kind of contentious one, it seems to be wind down planning and you know, the lack of sort of clear instruction on what constitutes a wind down plan. And you know, you need to have one, but we're not going to tell you what it looks like until we tell you it's wrong type approach. So we'll just do maybe a couple of minutes each on what, any one of those topics of your choice, if you've got strong views. We'll start with you, Mitch. I think you actually talked about de-risking earlier. So
indeed. So on the de-risking piece is much larger than just this current consultation paper, but indeed there's an entire de-risking seminar going on in 1 week today as well on this topic. But taking it away from de-risking, given the time that we've got, and moving more towards this consultation paper and safeguarding, I think the key parts that have happened as a result of wanting to put the temporary guidance into the full approach document, there's a lot of aspects that people are suggesting across the API EMI industry is really fundamentally changing how things are set up. And there's a lot of legal analysis that needs to happen, and why should it? And I know one of the challenges people are pushing back on their responses to the paper is safeguarding held on trust? And there's a couple of reasons why they're saying that. One, trust isn't a European concept. So it was never part of PSD or PSD2 that drove this. It's very much a UK and Commonwealth concept to suggest something's held on trust. And trust law is very, very deep. It can get quite complex. So I empathize with all of it. And in the interest of time, again, I think the one thing that the industry should look at is where does the argument need to be, right? As soon as we stay at the level of safeguarding the processes, is it trust, is it not? That's nuances of implementation. I think what would be great is to go all the way back up to base principles and say, what are we trying to achieve? We want to ensure that when a firm goes under, if a firm goes under, that consumers are protected, and that a solvency practitioner doesn't go in and say, haha, you've over safeguarded, I now have access to all those funds, because that's not really what it's all about. Isn't there an argument to say, look at the ledger? What is really due to consumers? Let that go first, then creditors fight over the rest. And that's really what we want to achieve. This idea of segregate immediately, safeguard end of day, look at your 5 days if you're an EMI, when that applies. They're all nuances underneath something that, my own personal opinion again, if a firm is going under, I genuinely don't believe that in those last 4 or 5 days, the analysts that are about to lose their jobs are going to do their safeguarding reconciliation at the forefront of their mind and make sure the money is moved, because human aspects will come in. They'll not be worried about their jobs and their work. They'll be more worried about where's my next role? How do I feed my family? At that point, when it counts, safeguarding reconciliation hasn't happened. I've taken 3 minutes. I'll pause.
Yep. Okay. Quickly, so Lara, your thoughts perhaps on that subject? Or
Well, I can spend an hour on.
I know you can. Yeah.
So everything that you said, Mitch, is absolutely right. The basic principle is you want to be able to identify clients' funds and whatever. But there are two issues with that. One, how do you legislate for that? Because if you have a concept of something that belongs to you, i.e. you've opened an account in your business name, that's your business name's account. That belongs to the business. And if you have clients' money flowing through that, regulators are limited. Anybody is limited in terms of what happens to that account, because it's in the business name. Hence the concept of trust. the way we can legislate for this and make sure that we do not cause harm to consumers and protect these clients' funds is to introduce the concept that whichever account you set up, even if it's in your business name, the funds in those accounts do not belong to you. So you can't do what you like with it. And that's the whole, gestation and the whole idea before it. And frankly, I think it's the best ever. I cannot argue with that, because it just means, and one of the reasons the FCA came up with this is that when it was just segregation, people couldn't identify which funds to segregate. We were co-mingling, and that was some of the things that was picked up, with Wirecard. And then it restricts your legal ability, to be able to have enforcement on something that is created as belonging to the business rather than something that is held in trust. So, I will not agree with you.
This would have been a great discussion. I think we're out of time, but
we are slightly out of time now. Yeah, we actually are over time. So guys, thank you for your contributions today. It's been fantastic. Maybe we need to set up another whole debate on this issue around trust accounts and safeguarding, because it is a fascinating subject, and it's wildly different across Europe as we've already identified. But let's move on from that. I'd like to thank you all for your participation today. It's been really, really good, really useful. Great hearing all these opinions, and let's get together sometime soon, hopefully in the real world. And for the rest of the day, thank you very much.